Suddenly everything's gluten-free, right? Gluten-free products are among the hottest sellers right now. So no wonder farmers in Kansas are panicking. Their biggest crop, it's a gluten-free cereal grain called sorghum, is now under threat. The state is the top U.S. producer of the ancient grain, and in the last 3 years exported $416 million worth of sorghum to China. In fact, the U.S. sends 80% of the cash crop to China, where it's used to make liquor and feed livestock as well.
Several U.S. ships bound for China came back after Beijing announced tariffs on our sorghum exports going over there.
I got to farm with my dad every day. It's a way of life. It's a wonderful way of life. And it's at risk. And it shouldn't be.
The impact of Trump's tariffs is being felt in the heartland.
Soybean farmers here are now suffering economically like they haven't in decades.
From overseas shows imports into the U.S. are down since the tariff war started, while exports to other countries are quickly climbing.
This means major powers such as China and India are finding other markets for their products. Madeline Rivera has more from Washington.
As the tariff wars escalate, America's trading partners could be adapting more quickly than anticipated.
South Africa is known to produce some of the highest quality stone fruit available and exports to markets in the Middle East, Europe and the UK. Now though, a new market is opening up after South Africa signed a stone fruit trade protocol with China, unlocking one of the largest agricultural import markets in the world. Stone fruit such as apricots, peaches, nectarines, plums and prunes will now be exported to China, and the agreement will be quite beneficial for the country's agricultural sector.
South Africa's announcement landed without fanfare, yet the implications were immediate and far-reaching. In a brief statement issued through diplomatic and trade channels, Pretoria confirmed a long-term agricultural supply agreement with China valued at roughly $200 billion, centered on sorghum exports and associated logistics, infrastructure, and processing investments. Within hours, analysts in Washington, Brussels, and London were recalculating assumptions that had governed African trade relations for decades. This was not merely a commodity deal. It was a signal, and it was received as such. For much of the past half-century, Africa's agricultural exports have flowed primarily toward Western markets, shaped by legacy trade agreements, development frameworks, and financial institutions built in the post-Cold War era. The United States, in particular, has long viewed agricultural trade as both an economic and diplomatic tool, binding supply chains to influence and reinforcing political partnerships through market access. South Africa, as the continent's most industrialized agricultural exporter, has occupied a central role in that system. Until now. Sorghum may appear unremarkable at first glance. It is not wheat or corn, nor does it command the visibility of oil or rare earth minerals. Yet globally, sorghum sits at the intersection of food security, biofuels, animal feed, and climate resilience. China's demand for sorghum has surged over the past decade as it seeks alternatives to traditional grain imports amid trade tensions, climate volatility, and domestic supply constraints. By locking in South Africa as a primary long-term supplier, Beijing has secured not only grain volumes, but strategic insulation from geopolitical risk. For South Africa, the deal represents something equally consequential: leverage. The agreement reportedly includes zero tariff access, Chinese investment in storage and rail infrastructure, technology transfers for drought-resistant cultivation, and financing mechanisms that bypass Western-dominated financial systems. In practical terms, it allows South Africa to expand production capacity without relying on US or European capital, while guaranteeing demand at a scale rarely offered by Western buyers. In Washington, the reaction was muted publicly but tense privately. US agricultural exporters have already been grappling with shrinking margins, rising transportation costs, and increased competition from Brazil and Argentina. Africa, long seen as a growth market for American agribusiness and food exports, is now increasingly positioning itself as a supplier rather than a customer. The South Africa-China agreement accelerates that shift dramatically. What unsettles US policymakers is not simply the dollar figure attached to the deal, but the precedent it sets. If Africa's most advanced agricultural economy can successfully pivot eastward at this scale, others are likely to follow. Zambia, Tanzania, Nigeria, and even Kenya have already expanded food and commodity agreements with China, India, and Middle Eastern partners. The cumulative effect is a slow erosion of Western pricing power, market influence, and political leverage. China's strategy is methodical rather than abrupt. Unlike Western trade frameworks that often attach governance, labor, or political conditions to market access, Beijing's agreements tend to emphasize long-term supply security, infrastructure development, and non-interference. For African governments under pressure to deliver jobs, food security, and export revenues, the appeal is obvious. Critics argue this creates dependency, but supporters counter that Western systems created their own forms of dependency decades earlier. South Africa's leadership has framed the deal as pragmatic rather than ideological. Officials emphasize diversification, noting that reliance on any single market exposes exporters to sanctions, trade disputes, and currency volatility. From that perspective, the China agreement is less a rejection of the United States and more a recalibration of risk. Yet geopolitics rarely allows such distinctions to remain neutral. American influence in Africa has historically rested on three pillars: security cooperation, development assistance, and market access. Over the past decade, each has come under strain. Military partnerships face domestic scrutiny across the continent. Development aid is increasingly supplemented or replaced by Chinese and Gulf financing. And now, market access, once considered Washington's strongest card, is being challenged by competitors willing to commit capital at scale. The Sorghum deal also intersects with broader global shifts in food security. Climate change has disrupted harvests across North America and Europe, pushing prices higher and reducing export reliability. Africa, despite its vulnerabilities, possesses vast underutilized agricultural potential. With sufficient investment in irrigation, transport, and technology, it could become a net food exporter to the world. China's willingness to fund that transformation gives it early mover advantage. Economists note that the $200 billion valuation likely encompasses more than raw exports. It reflects decades-long supply commitments, price stabilization mechanisms, logistics contracts, and downstream processing investments. Chinese firms are expected to participate in milling, storage, and bioindustrial applications within South Africa, embedding the partnership deeply into domestic supply chains. Once established, such systems are difficult to unwind. For American farmers, the implications are indirect but significant. Reduced African dependence on U.S. grain imports weakens demand, while expanded African exports increase competition in global markets. At the same time, U.S. agribusiness firms risk losing ground in regions they once dominated through technology, seeds, and financing. The competitive landscape is shifting faster than many anticipated. Politically, the deal complicates Washington's Africa strategy at a sensitive moment. U.S. officials have sought to counter China's growing presence by emphasizing shared values, transparency, and sustainability. Yet for many African leaders, immediate economic outcomes outweigh abstract assurances. Jobs created, exports secured, and revenues stabilized carry tangible political benefits at home. South Africa's decision also reflects domestic pressures. Rising unemployment, energy constraints, and fiscal strain have forced policymakers to prioritize growth wherever it can be found. Agriculture remains one of the few sectors capable of absorbing labor at scale while generating export earnings. By securing guaranteed demand from China, the government can justify expanded investment in rural areas that have long felt marginalized. Critics within South Africa warn of over-reliance on a single buyer, cautioning that China's market dominance could eventually translate into pricing power unfavorable to farmers. Supporters counter that the diversification away from Western markets actually increases bargaining strength. Both arguments underscore the strategic nature of the choice. From Beijing's perspective, the agreement aligns neatly with broader food security objectives. China has made no secret of its concern over supply disruptions caused by trade wars, sanctions, or climate events. By anchoring food imports in politically stable partners across Africa, it reduces exposure to any single geopolitical theater. South Africa, with its established institutions and export capacity, represents a particularly attractive partner. International reactions have been telling. European officials have expressed concern quietly, recognizing that similar agreements could erode Europe's own agricultural export position. Emerging economies, meanwhile, see the deal as validation of South-South trade models long discussed but rarely executed at scale. What emerges is not a sudden collapse of U.S. influence, but a gradual redistribution. Power shifts in the global economy rarely announce themselves loudly. They accumulate through deals like this, technical, transactional, and initially unremarkable, until their combined weight becomes undeniable. The South Africa-China Sorghum Agreement does not end America's role in Africa, but it does mark a turning point. It demonstrates that African economies are no longer waiting for Western approval to chart their trade futures. They are negotiating directly, at scale, and with long time horizons. For Washington, the challenge is strategic rather than reactive. Competing in this environment requires more than rhetoric. It demands capital, patience, and a willingness to treat African partners as equal stakeholders rather than peripheral markets. Whether the United States can adapt quickly enough remains an open question. As shipments begin, rail lines expand, and contracts lock in, the deal will fade from headlines. Yet its effects will continue to ripple outward, reshaping supply chains, alliances, and assumptions about who sets the terms of global trade. In that sense, South Africa's agreement with China is less about sorghum than sovereignty, less about agriculture than agency,